So let's go with an example. This example, I pull it out, I just look at the chart and chose this example. By showing you one example, this doesn't mean that it happens all the time in price. It would happen in your preferred session, in your preferred asset all the time. All I'm telling you is that this is what ICT teaches, and then it becomes fancy and refined and more complicated. But honestly, the theory behind it is not that complicated. The refinements are understanding price action and what price is telling you is perhaps harder. But if you have a framework where with a way to analyze the market, it's not going to be that hard for you, because honestly, this is not the hardest part. We have 4 impulses. Okay, we have a bullish impulse, we have another bullish impulse, which is the number 2, then we have a bearish impulse, and then we have the 4th that is also a bearish impulse. I told you that I define the impulses as strong moves that break structural points. Okay, so let's go with the first impulse. Price is going up strongly and then it comes back. It doesn't even tap into the 50% level. So price doesn't go to discount. Oh, what a surprise. It doesn't. Do you know how many times this happens in I don't know, in 100 different impulses? How many of them don't even go to the 50%? That's your job to find out. This second impulse breaks the highest high. That's enough for me. It does it with body. That's enough for me. I know you can sometimes you're going to map structure and you're going to think it's wrong. Like, oh, if I change this way, I could have taken this move too. For example, what would someone who's not trading a system doing? For example, you have the first impulse, I have the second one, and then I have a third. But someone would say, oh, but if I join 1 and 2, because 2 is not that strong, it doesn't look like it's a different move. If I join 1 and 2, then definitely I get a reaction in below the discount of that compounded impulse. I don't know if you can follow me, but this is biasing your narrative, and I don't care. I define impulses like this. I'll stick to it. If it doesn't work, only hundreds and hundreds of examples will tell me that, hey, perhaps it's a good idea to sometimes join to impulses and find a reaction there. Okay, the second impulse, it's bullish, but price doesn't give you a reaction below the 50%. The third impulse that forms by breaking the lowest low at the moment, it's a bearish impulse, and price retraces back, goes into the premium zone, and we have a decent price delivery. Okay, so those are the four impulses that I see. Of course, we're going to try to see the lower time frame. This is in the 4-hour time frame, so our lower time frame would be 15 minutes. Okay, let's go to the 15-minute in each case. In the first one, we don't have a price below the 50%, so it's not we're not going to study that price action in the 15 minutes. Okay, in the second impulse, and this is by far the thing you would like to happen the most. Price went below the 50% in the 15-minute chart and didn't give us a single bullish reaction. There is no bullishness here. There is no market structure shift. There is no break of structure to the upside. So we saved a trade here. Where other people use these trades without confirming, we already saved that trade. Okay, but sometimes it will give you confirmation. And if you don't have proper risk management, you're going to burn your account. If you get a reaction here, you have more probabilities, but it's not 100% certain. Now, let's go to the third move. The third move is a bearish impulse. So we waited for a reaction above the 50%. Okay, right now I'm not focusing in if it happened in the fair value gap, if it happened in an order block, if it happened in the 61 or the 79%. I'm just focusing on a reaction in the premium zone. Okay, so we go to the 15-minute chart and what we see. According to my own understanding, we have a first market structure shift with imbalances and everything, but this doesn't work as good, and price stopped us. This is okay. Now, what happened in these cases? First, what I see that people think is that if I choose another element in the premium zone, perhaps I don't have to lose this trade. Bullshit. Okay? You cannot explain why a trade hit stop loss. You just can't explain why you entered the trade. This trade was good. This was a good trade. Price went into the premium zone. I don't care if you see liquidity. I don't care what you see in there. I don't care if you see, oh, there's an imbalance above. Of course, there's a fair value gap. It's obvious. It's not obvious because the same Michael said, you don't know which element is going to give you the reaction. Okay, so this is a valid trade and it's not a bad one. It's just, it hit stop loss. It was in the negative probability. And every time I see someone asking, how can I improve this? You cannot improve it. Because this is part of your system if you trade this way. Okay, so stop trying to find out how to refine your trades because you're going to end up frustrated. Okay, so this trade was a bad one. This trade was a good one that failed. And we had another bearish reaction above. This was a trade that worked, as you can see. In the 4-hour chart, it worked and it delivered to the next lowest point. That is what you're aiming for, theoretically. That's another story. What are you going to aim for? That's another story. Okay, now we have another break of a structure to the downside. Now we have that bearish impulse. Now, there are a few highs that you could use to consider the impulse starting from there. But I have a very, I would say, systematic way to know which high I'm going to use. If you want to know that, just ask in the comments because I can redirect you to who's the one that taught me that and I can explain it. But only when it happens to you, you will understand how biased and how unrealistically subjective you can be when watching the market. Okay, so price went above the 50% again. I don't care. There's a wick there. I don't care. There is an order block. Yes, it is the 62%. Oh, what a coincidence. Okay, it's not a coincidence. It's just that you don't know exactly which element is going to react. Which resistance level here is the one that you're going to try to trade. Okay, so let's see what happened inside those. Now, inside this premium zone, price gave us another type of bearish reaction, which is the formation of a bearish order block. This bullish candle that you see here, once price trade below that candle, this validates the bearish order block. And I'm literally repeating Michael's words, and I'll show you in the end of the video when he explains something exactly like this. And now you are starting to see how complex can it be.